Hey guys, welcome back to another exclusive podcast from IronFX. At IronFX, we are dedicated to bringing you the absolute best trading education to help you take your trading to the next level. In today's podcast, we'll be talking about 10 easy tips to know before you start trading. So tip number 1, you have to create a trading plan. So many forex traders are actually guilty of being too eager to start trading straight away without setting out a clear plan beforehand. As the cliche goes, if you fail the plan, you plan to fail. And same goes to forex trading. So you can think of your forex trading plan as a set of rules for you to follow when you trade and how you will actually implement them. Defining these rules beforehand and writing them down will help you stick to them while you start trading. So here are some questions that I usually ask myself. Number 1, tip 1, what are your trading goals? Whether they are long or short term. Whether they are long or short term gains. Number 2, what is your trading style? Are they technical analysis or fundamental analysis? Number 3, how much time will you spend daily trading these markets? Number 4, what will determine your market entry and exit? What are some strategies you have picked up? And number 5, how much can you afford to risk, which is risk management. Creating a trading plan can help you prevent overtrading, which can result in a lack of concentration and reckless trades. As you develop your trading plan, set yourself a maximum number of trades you will take per day or per week. So make sure you always manage your ticket sizes as well. Probably start with something more comfortable, something that you can afford. Tip number 2, select your market or instrument. Research a market and decide on whether you are comfortable with the level of volatility. Do you want to try and make a short-term gain? Or would you prefer to look for gradual profit accumulated over time? If you're searching for short-term gains, then you will probably be looking at fairly active markets with quite a high daily range in comparison to price spread. A tight bid and offer spread also equates to a reasonable amount of liquidity, which is positive. Should things go against you, such as a fast-moving market, this will offer a great opportunity to close the position. Tip number 3, define your objectives. So one of the most important rules is to trade with the trend. If the market is going up, place a buy trade. And if the market is going down, place a sell trade. It's probably not so sensible to attempt to pick the top or the bottom. Never try to pick the top or bottom, which everyone often does. If the market is going up, decide where you want to buy and place your trade. And at the same time, if you're looking to sell, look at where you want to place your selling position. You should always have a risk management strategy with predefined stop loss and take profit levels. So one key advice that I would give to my audience, you should never trade for the sake of trading it. Do not be impulsive when it comes to trading. Being neutral is also a good position. Tip number 4, keep it simple. It is actually a sensible idea not to overcomplicate your analysis with a variety of different indicators, be it technical analysis or fundamental analysis, as sometimes they can give you contradictory signals, which could lead to cluttered thinking. The basic key questions you should ask yourselves are, is there a clear trend, yes or no, uptrend or downtrend? If there's a sideways trend, do nothing. And always look for support and resistance areas and then decide whether to place a trade or not. So keep things simple and clear. Number 5, practice and start small. Put your trading plan to test in the real market conditions with a risk-free practice account. You'll get a chance to see what it's like to trade currency pairs while taking your trading plan for a test drive without risking any of your own capital. So once you are comfortable, You can then move into a small funded account. You should start probably with an amount you can afford and be comfortable with. If you need to, you could actually probably skip the shopping or poker session over the weekend. A common mistake made by a lot of traders is to dive straight in, meaning once you have learned and educate yourself in trading, you just put an amount into the trading platform. But what I would recommend is to start with a risk-free practice account. So you shouldn't be entering a trade until it's been well thought of. And when you do, start small. Always start small. Always have the mindset of slowly but surely. The key here is to build your confidence as well. There's no such thing as beginner's luck in trading. When you start, you will lose money on some trades and make some on the other. Tip number 6. Get used to being wrong. Even the most successful traders, the best traders, the most professional traders make mistakes and lose money occasionally. So as a beginner trader, you need to accept that you are going to be wrong from time to time or many times, particularly in the beginning. Being wrong and making mistakes are unavoidable consequences of learning to trade. And the sooner you accept this, the better. If your last trade was a loss, try not to be obsessed over it and don't let it impair your decision-making process on the next trade. Instead, analyze your mistake and try to learn from it. Tip number 7, keep a trading diary or a trading record. Do keep a record of your past trades, for example in an Excel, written down, or keep a diary. Keeping this diary is an excellent way for both beginners and experienced traders to improve their trading strategies and develop their skills as a trader. A good diary should record details about your trades regardless of whether they resulted in a win or loss. By regularly setting time aside to go through your historical trades, you can see what you did right and what you did wrong. And most importantly,